Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good afternoon, everyone. Welcome to the next episode of Financially Fluent. Today, we'll be talking about Roth IRAs, which I love them because they're really good for all ages, whether you're a 2-year-old or a 100-year-old, everywhere in between, you might want to think about a Roth IRA. And for today's show, we got Cindi Walters from our team. Welcome back, Cindi. And we have a new person on, which is our summer intern from the wonderful Georgia State University of downtown Atlanta, finance major, Gavin. Say hi to everyone, Gavin.
Yeah, hello everyone. Thank you, Ray and Cindi, for having me on today. And yeah, we'd love to talk about Roth IRAs today.
Excellent. Yeah, I know you're about to be a senior, and so I think you got good days ahead of you. It's been wonderful having you here on board, and of course, Cindi and I have been together for a while, so it's awesome to always have her on the show when we can.
Thank you.
But yeah, let's just get right to it. I know you both have questions today. Cindi, fire away. What do we got?
Can you start by explaining exactly what a Roth IRA is and how it's different from a traditional IRA?
Yeah, so Roth IRA, IRA stands for Individual Retirement Account. So that's true whether it's a traditional, which is what they call pre-tax, where you're getting a deduction on the way in, but you got to pay tax later. The Roth IRA, you're going to get, both of them you get tax-free growth, but the biggest difference is on the Roth, you're going to take that money out later tax-free. So there's a few rules around making a qualified withdrawal. Roth IRA, has more investment options than a 401k. So that's always important. We might be able to remember that. You could put money in a Roth and you got lots more investment options than you would in a 401k. But in a nutshell, that's what it is.
Okay. And why do you think the Roth IRA has gotten so popular in recent years?
Yeah, it really has. It's gotten very popular. I think some of it's just education, to be honest with you, and just awareness that it's out there. There's a lot of people way before me talking about it, whether it's through blogs or podcasts. People believe that taxes are going up in the future. Was that true? Nobody knows. But when the national debt is at $36 trillion, that's roughly about 120% of GDP. It's just math. There's a really good chance that the tax rates are going to go up into the future. And so that's just not a good trend. And so with a Roth IRA, you just have greater control of when you take out distributions later on how you're going to be taxed. Yeah.
All right, Ray, I have a couple questions for you. Since this question is coming from me just because I'm a college student myself, I wanted to ask, who would benefit most from having a Roth IRA? Is it mainly for young investors?
Yeah, so I love this question because we are recording this on July 3rd, right? Tomorrow we're going to celebrate, our independence and our freedom. And to me, a Roth IRA gives you freedom because when you take that money out later, you're not worried about the tax man, right? Because you're taking out the money tax-free. So for young investors, it is very attractive for a couple reasons. It doesn't mean that everyone that's young should do them, but it does mean that you've got time on your side. So if you're putting in money into a Roth today and all of a sudden it's 30 years later, you're taking that money out. But I've seen people in their 60s, they'll make, Roth conversions. So it's not just for the younger crowd, but certainly when it comes to having more time on your side for that to compound, the younger age group might benefit from it.
All right, yeah, of course. All right then. And then are there any income limits that could disqualify someone from contributing directly to a Roth IRA?
Yes, there are. And so that's where really each year it changes. So we have a kind of a 2-page PDF that we like to send to people at no charge that talks about income limits. So for 2025, if you're a single person or head of household, as long as your modified adjusted gross income is under $150,000, you can put money into a Roth IRA, no problem. There is a phase-out amount between $150,000 and $165,000 of income. And there you wouldn't be able to pull a full amount. And for our married filing joint clients that are out there or people that are out there, the income limits for that is pretty decent. If you're making up to $236,000 or less, you can do a full contribution into a Roth IRA. The phase out for that is going to be between $236,000 and $246,000, Maggie. And then Now, do remember, you got to show income to put money in it. So you can't just make a contribution if you didn't make any money. Except for, let's say you're doing a married file joint return, there are spousal Roths someone could do. So maybe one of the spouses has a year off, they don't have any income, but they're below that income threshold. They could both put money into the Roth IRA. As a matter of fact, minor children are eligible to put money into a Roth IRA. Again, you got to make money, right? So you couldn't make $5,000 and put $7,000 in it. You'd have to make more money than you're putting in. And of course, the minor wouldn't control the account. It would be a custodial account, but it'd still be in their name for their benefit. And the other category would be if you're married and you're doing a separate return. Those cases, probably only one of you would have any chance to put money into a Roth IRA because you can only make $10,000 just a gross income to be able to put money into one of those. If you're doing separate returns and one of them's making more than 10 grand, you can't do it. And the last thing I want to say about this would be, well, what if somebody's making $250,000 of gross income, right? That's the family, that's the family income gross. Well, by the time you're putting in money in a 401k pre-tax and you're putting the HSA contributions, you could very easily reduce your adjusted gross income down to a threshold that now allows you to put money into a Roth IRA. So, yeah, good question.
Okay, that's interesting. And then I think you mentioned this a little bit, but what are some of the contribution limits for year 2025? And are there any catch-up rules for people over 50?
Yeah, that's right. If you are anybody that's making that money, like I said, you could put in up to $7,000 in contributions per year. And then if you are 50 and better, or 50 and older, as some people say, you could do a $1,000 contribution. And then just remember, the other thing is, let's just say it's March, the year you're filing your taxes, and you haven't filed your tax return. Before filing that tax return, you could put money in today to count towards last year's tax year. So we've had people that come to us before and we're literally putting in $7,000 one day for one tax year and $7,000 in another tax year. So you could, in theory, put in it, 14 grand in 1 year, but you just got to count one towards one tax year and one towards the other tax year. Good question.
Okay, got you. And then could you talk about some of the withdrawal rules, specifically like when can someone take the money out without incurring a penalty? Okay,
so that's what I like about the Roth. You mentioned younger people earlier. When you put money in a pre-tax account, you're getting like a traditional IRA, you're getting a tax benefit on the way in, and you're probably going to have a hard time avoiding, there's a few exceptions, but you're going to have a hard time avoiding that 10% pre-withdrawal penalty. So even if you're below, younger than 59 and a half, you can take the cost basis out. So let's just say somebody put in $14,000 2 years later, and maybe the account value is $18,000. They could take up to everything they put in without a penalty and without it being taxed because they've taken money that they didn't get a tax benefit on the way in, right? They've used after-tax dollars to put the money in, and now they're going to take that money out. So again, for someone that's younger, that's a little bit of comfort versus putting money in that, you can't touch for 30 years without some kind of a penalty. So that's nice. But aside from that, the growth you would not be able to take out. So that's where, if you're 59 and a half, you've had a Roth IRA open for 5 years, then you could take it out tax-free. So good question.
All right, I'm going to jump in with a few questions for you, Ray. Why is a Roth IRA so powerful when it comes to retirement tax planning?
It's going to help you control your distributions. It's so hard when we're working and we're putting money away, we're looking for tax deductions, and then all of a sudden one day, we're not doing that anymore, right? So we're taking money back out of these accounts, 401ks, traditional IRAs, Roth IRAs, joint taxable accounts, right? We're taking money out. So if you have a Roth in your plan, you just got better control on how you're taking money out to avoid certain consequences, such as Medicare surcharges, or if you're trying to maximize your Social Security, you have a strategy, a plan in place, it can affect that. The other thing I'll say is, let's just say you put in $7,000 into a traditional IRA, right? And maybe your effective tax rate's only 20%, right? So you're gonna get a $1,400 tax deduction, but then that account grows and it's $100,000 later, and now you got to take out, and maybe you're at a 30-something% tax bracket, and you're going to take out, you're basically going to get taxed at $30,000, out of a $100,000 account. So had you chosen the Roth, and maybe you delayed that instant gratification of a $1,400 tax break, and now later, instead of that $100,000 account being susceptible to tax, you're taking out $100,000, no tax on it. So I like that. Yeah, those would be some of the things.
If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
You've mentioned tax diversification. How does a Roth help with that?
Yeah, so again, you kind of just maximize your taxable accounts with long-term gains and interest and dividends you get from those. It's a way to mitigate future tax rates that might change. Tax brackets could change. If you have an account where you got a tax-free account, you've got a tax-free later account like a pre-tax 401k, IRA, and you also got a taxable account. You just got more moves to be able to make, and it all kind of works together when you're thinking about the impact that you may have. Again, kind of leading back to the previous question about Medicare surcharges, optimizing Social Security benefit.
What is a Roth conversion, and when does it make sense for someone to consider that?
Right. So Roth conversion is where you have a pre-tax account, right? Often that's in a 401k or a traditional IRA, and you choose to take some money out of that and convert it to a Roth. And when you do that, let's just say you did $10,000 conversion, that $10,000 will be added to your income for that year. And so you will pay a tax on that based upon your tax rate. So from a timing perspective, if you think that your tax rate in that particular year is going to be less than in the future, that might be a time to do it. So maybe someone's got, a loss of income, or they had a bad year in their business owner. There's any number of reasons from a timing perspective you might want to do it. From a strategy perspective, we'll often do what's called a fill up the bracket strategy. And usually we're going to do this before RMD age is, required minimum distributions. Usually we would do it then, and we kind of do this fill up the bracket strategy, whether that's fill it up to a 22% bracket, 24%, whatever it is, or say a $250,000 adjusted gross income. There's certain targets you want to do, and you can do that. And by being kind of real tactical at it, you just find yourself having more dollars in a tax-free bucket later. The only thing, or one of the things I would mention, you got to be careful, because there are Medicare surcharges, and they're looking at a 2-year look back. So if you're doing a Roth conversion and you're doing it kind of the wrong time, the wrong year, you may mess yourself up later when you have to pay Medicare, and now you're paying more for your Medicare premiums than others. So what you want to look for is, well, can I do this in a year that I have less income, or I'm retired, or unfortunately, became single again, whether it's through divorce or death. Those are kind of those optimal times you might think about doing a Roth conversion, so that it doesn't kind of mess you up in the future with respect to Medicare surcharges.
Okay.
Then, there's people that they convert Roths later, right? Maybe they're way into their retirement. They've heard of the Secure Act. They now see that their grown children are doing quite well, right? Their grown children are making really good income, and now they're a little concerned that from a inheritance standpoint, that if they're getting some big pre-tax account and their grown children are having 10 years or less to take money out of the account, it's going to impact their taxes across the board. So there's some estate planning, and you're going to take that older person might convert it into a Roth. They're going to pay the tax on it, but at least, from an inheritance standpoint, they're not have to worry about, that impacting their kids. One other little caveat that's important to understand: required minimum distributions. You do not have that. If you own a Roth IRA, you don't have RMDs. You don't have to worry about it if you're the owner, okay? But if you're in a pre-tax account, there you do have RMDs. You're going to have to take money out of those accounts. And when you take money out of an RMD, What you can't do is take money directly from a pre-tax account that's an RMD and goes directly into a Roth. You're not going to be able to do it. So what you got to do in that situation is the RMDs are satisfied first. So those amount of dollars come out first. And then after you've satisfied your RMDs, if you want to still convert money into a Roth, you could do it. It's just all that is going to be income. So I don't think that's going to happen a whole lot. It does happen in certain situations. So it kind of gets back to the importance of planning and why someone might want to do those conversions prior to turning on Social Security, but certainly prior to the R&D age happening.
Okay.
Okay, Ray,
Thank you.
I have a couple questions for you about some common myths or mistakes. So what's one of the biggest misconceptions that you hear about Roth IRAs?
There are so many, but let me just, before we get into that, I want to kind of just touch on from estate planning earlier. When you're doing estate planning, you got to think about, some people just think to themselves, hey, I want to put 10% to a charity or a church. That's great. It's noble. I love it. However, you could think about the Roth IRAs probably should go to your natural persons, right? Because that's tax-free. And then your pre-tax accounts, where you got a tax benefit and somebody's paying a tax later, those you can actually have those go towards the charities, because the charities won't be taxed. So I didn't mention that earlier. I wanted to kind of, while it was on my mind, think about that. Same thing with trust. Maybe you have a trust as a beneficiary. If you're doing that, make sure it's a see-through trust, especially if it's a pre-tax account. Even if it's a Roth IRA, if you have it as a trust as a beneficiary, and if it's not a see-through trust, you would get a tax-free. You still get tax-free benefit, but you have 5 years to take it out instead of, say, 10 years. So I want to touch on that. But from a misconception standpoint, I've heard people say, I can't do a Roth IRA, I make too much money. And so you could do a backdoor Roth, which is people put money in a non-deductible traditional IRA, so there's no tax deduction on that traditional IRA, and then they convert it to a Roth IRA. Some people call that a backdoor Roth. I'm going to say be careful on that, because they have pro rata rules, and it can get a little tricky if you have multiple IRAs, multiple accounts. You could have some unintended consequences, so be very careful. I think the simplest thing to do that is your employer may have a Roth 401k option. Some people are unaware of that. So that to me is a simple way to do it, because there's no income limits inside that 401k. So you can make $300,000-$400,000, and if your employer offers a Roth 401k and you want to do 5% towards that, 10%, whatever, you can do it. So that's one. A second one would be, I can't touch my Roth IRA until I'm 59 and a half. And we kind of touched on this earlier, and not really true, right? Those after-tax dollars, right? The money you put in, you'd already paid tax on the money, and you decide to put money into a Roth IRA. And you want to get what the amount of money you put in, you take that money back out. There's no tax or penalty on them. It's only the earnings. You got to worry about the 5-year rule and being 59 and a half. Another misconception would be Roth conversions. So here, let's say you're 58 years old, right? And you did a $100,000 conversion, and you never had a Roth before. And now it's 2 years later, you're 60 years old, and in that $100,000 account, let's just say you've done pretty good. Now it's worth $120,000. And you really don't want to take money out of your other accounts that year. You could take out $50,000 out of that account, no problem, right? You take that money out, and you don't have to worry about the 5-year rule. You don't have to worry about the 10% penalty, because you're already past the age of 59 and a half. On that note, I'll say this too. There is no resetting of the clock. So some people think, I opened up a Roth account and then I closed it, so now I got to restart the 5-year rule. That is not the case. That clock starts as soon as you open up a Roth IRA, because you're going to put on your tax form that you made a contribution to a Roth IRA in tax year 2005, 2025, whatever. That's really important to understand. I've seen people, they may be in a Roth account, maybe they don't like how the investment side going, and they're afraid of doing anything with it and restarting the clock. And just want to kind of mention that's not true. You can absolutely, you could close that, transfer it somewhere else, anything like that. And that kind of gets back to, I would say, opening up one sooner than later. So there's no required minimum distributions as an owner of a Roth. So keep that in mind. And again, for beneficiaries on the other end, they will have RMDs. So if your grown kids get a Roth IRA, even though it's tax-free, they got 10 years left to take the money out. I'm going to keep going here with misconceptions because there's so many. I think the last one we'll probably talk about today would be you should never have an annuity be inside of a Roth IRA. I wouldn't say that's true either. It depends, right? So if you're trying to accumulate value and maybe, whether it's any number of strategies, could be a FIA or RILA, anything like that. It's inside of the Roth, so you haven't changed it at all. It's because whether you invested in ETFs, mutual funds, stocks, or an annuity, it's still inside of that Roth IRA shell. So that would be true. Even if you did an income play, hey, I just want income for life out of this SPIA or something like that, as long as it's inside of a Roth and it's you want to make sure it is a qualified distribution, that you're at the right age, right? You could do that and it would not be taxable.
Yeah, right. That sounds really great. And I have another question for you. Is it ever too late to open or contribute to a Roth IRA?
No, it's really not, right? It's never too late. It's really specific to someone's situation, but I would say we got people that you could be, got a lawn mower business, right? You want to put some of this money in a Roth, you can. Let's say you're a parent and you're you're a business owner and you're utilizing small children, I guess, from a marketing perspective. They're getting paid, they're earning the income. You could have them get a Roth. And like I said earlier, someone that's super older in age, right? They could still do a Roth conversion into their 90s. So yeah, there's no time you can do it whether you're young or old.
All right, got it. Thank you, Ray.
Okay, Ray, if someone listening today thinks a Roth IRA might be right for them, what would be their next step?
Yeah, so if you think a Roth IRA is next step, you would want to reach out to an advisor, or if you're doing things on your own, check with your custodian and try to open up a Roth account. You're always welcome to visit our website. There's a lot of tools on there, southeastwealthpartners.com. If you have questions about it and you want us to answer the questions online or offline, just send it to ray@sewealthpartners.com.
One more question for you, Ray. Should you still consider a Roth if you already have a 401k through work?
Yes, you should. If you have a Roth IRA, so in a 401k, the employer is dictating what investment choices you have, right? And you may not be able to get money out of there as easily as you'd like. So you could have a Roth IRA, that is your account, whether you want to decide which investment choices you want, or you have an advisor that can help you. So you got way more investment options in a Roth IRA than you would a 401k. Good question, Cindi.
Okay, that's all I have for you today.
Yep.
Excellent.
Same with me.
Well, we're not done because we have trivia. That's how this is going to work. Here's our trivia question. It will be multiple choice, and whoever, you both get one shot at it, getting that answer correct. And I'll say 3, 2, 1. I want to hear your guess at the same time. So questions asked, choices are given. 3, 2, 1, give me an answer. So here we go. Which U.S. state has the most freshwater shoreline of any state? Your options are Florida, Alaska, Michigan, Minnesota. 3, 2, 1.
Minnesota.
Gavin, did you say Michigan?
Yes.
Oh, you are correct, sir. Nice job. Nice job. I would not have guessed that. So
Thank you.
excellent. But thanks for saying Minnesota, Cindi. I'm going there at the end of the month, so I'm excited about going up there.
Fun trip.
They do have a lot of fresh water, but I think it's kind of like lakes and stuff, land of lakes. So cool. Well, that was fun. Thank you for playing. Gavin, thanks so much for hopping on.
Yeah, of
You have a
course.
good experience first time on Financially Fluent?
Yeah, it was really good. It was very informative. I got to learn a lot of new things. Yeah.
Awesome. Cindi, our repeat offender, thanks for coming on.
And it's always fun to be on.
And for listeners out there, feel free to share and subscribe, like this. We'll see you next time.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.